Gil Luria of DA Davidson staying bullish on Microsoft going into the results and writing Microsoft will be the key earnings report of the entire season. Capex guidance for fiscal 27 will determine the direction of the market. Gil joins us now for more. Gil, key question then, why is this the key one? Why this one name? Why is it so important?
For a couple of reasons. One, this is Microsoft's fiscal year end, so they're going to guide for 12 months for a full year, and they'll give us a hard number. So we'll be able to pin down how fast that CapEx growth, to Ed's point, is it growing even faster than Azure, or is it growing slower than Azure will be the key question. And the other reason is Microsoft has been the responsible adult in the room around CapEx for the last couple of years. It was about a year and a half ago that when we were worried about the direction of AI, that they actually did step back CapEx a little bit. So that's why investors are looking to them to see if they're going to blink. They're more likely than Google, Amazon, Meta, et cetera, to blink. And that's why investors are trepidatious walking into this earning, is if Microsoft says they're reining in CapEx, that's going to be tough for the AI trade. We don't think they're going to say that.
Do you think that increasingly as CapEx has to go up, regardless of some of the pushback that you're seeing in capital markets, do you think that the better investment thesis is shifting to the bond space, to the credit space, and away from, say, buying the equity?
Well, to the extent that the bonds for these mighty companies, Amazon, Microsoft, and Google, are starting to trade at a discount, that does seem like a relatively safe bet here, because these companies are incredibly credit worthy and they all have the ability to stop CapEx on a dime. They could go to a fraction of their current run rate and still grow their business. They just believe, and they're trying to show us evidence that this investment is showing a return. But if at some point they decided it's not, they'll scale back CapEx and their cash flows will skyrocket. That's why these companies are more creditworthy than almost every country in the world. It's because their flow of cash is very reliable. It's almost like a global tax that these big companies have. Therefore, any discount to their debt is probably attractive.
Does it help them that you're seeing dislocation in some of the semiconductor names and pushback, potential competitive pressures coming from elsewhere when it comes to manufacturing some of the components?
It gives them a little bit more operating leverage vis-a-vis the chip companies. But realistically speaking, none of these companies is going to buy chips from China. And if that's the concern about competition, that's not that much of a leverage point against NVIDIA, Broadcom, Micron, et cetera. Those companies will continue to get the 75% gross margins as long as we continue to ramp the data center build out. But they'll certainly try.